One of the things that keeps people from investing in real estate is all the different lingo that's involved, from cap rate, NOI, IRR, and depreciation. I understand it can get a little bit confusing, but if you want success with anything in life, you've got to invest in yourself first. And in this case, it means taking the time to understand what metrics to pay attention to before you invest your hard-earned money. And one of those metrics we're going to discuss today is called the preferred return. And in this video, we're going to discuss what's a preferred return, how to calculate it, the pros and the cons, and an example to bring all of this together just for you. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist helping to educate you about working smarter and not harder. Do me a favor, download the passive income guide that's below this video. Let's get going. So let's start off with addressing the question, what exactly is a preferred return, or also known as a pref? Most of the real estate syndications, including the ones that I'm in, they use bank debt for leverage. Typically, before any of the limited partners or the passive real estate investors receive a return on their investment, debt is repaid first with interest before the interest on the principal is paid back. So let me say that again. Before any of the limited partners receive a return on their investment, debt is repaid first with interest before interest on the principal is paid out. Now, the cash flow distributions that are returned to you and I, the passive investor, before the general partners get paid is called the preferred return. Now, when the limited partners have priority when distributions are made, this is an example of a preferred return. As a result, they receive 100% of the profits until a preferred return hurdle is reached. As you can imagine, having a structure like this incentivizes the sponsors to perform the best they can. Otherwise, guess what? They don't get paid. Now, a sensible general partner typically won't undertake a project if they don't feel that they can significantly outperform this preferred return. So, for example, if the preferred return is 7%, but there's only enough cash flow to make a 7% distribution, the sponsors typically don't receive distributions until that property begins generating cash flow. Now, let's talk a little bit about what's called a true pref versus a pari passu preferred return. Now, preferred returns can be structured in several ways. So, for example, in the true preferred return, passive investors are going to receive a preferred return up to a predefined percentage before any capital is returned to the sponsor. All right. On the other hand, if a syndication is structured what's called a pari passu, which is Latin meaning on equal footing arrangement, the sponsor, the general partners, and the limited partners are actually treated equally up until the rate of return threshold is met for each. Now, once this is accomplished, any returns above this point are unequally favored in favor of the sponsor, who is then said to be making a promote. So the sponsor promote refers to the share of profit paid to the general partner, or in this case, we'll call him the promoter. So again, the sponsor promote refers to the share of the profit paid to the general partner in exchange for basically going above and beyond the expectations, whether they achieve them or exceed expectations. That is their promote. So next question, do preferred returns accrue? Typically, the pref interest in a real estate syndication, it does accrue. If at any time during the hold period an investor isn't paid the full percentage of their pref, they'll accrue the deficit of the pref percentage. During the following year, they'll be in line to be paid first, plus the previous year's deficit that's actually carried over. For example, many times during the first few months of acquiring a property that needs rehab, expenses, as you can imagine, can be very high. Now, if the sponsor is not able to distribute the pref return to investors because of this, then the percentage of the pref deficit is accrued rolling over to the next year. In this particular example or situation, the passive investors would receive all the distributions of the profit, and the sponsor, the general partners, would not receive distributions, and then the deficit would actually accrue and then be paid out on top of the distributions for the following cycle. This is why most passive investors prefer a pref, due to the fact that it provides them a level of safety and confidence within their investment. Now, there's multiple different ways that these preferred returns can be structured. The first one is called a hurdle rate. And the hurdle rate basically means it must be surpassed before, this is a rate that must be surpassed before the general partners are paid. For example, a pref hurdle of 7% means that the passive investors must achieve a 7% return before any other money flow occurs. Now, return hurdles can range anywhere from 5 to 12%. Most of the syndications that I'm currently in range anywhere from 6% on the low end to 9+% on the high end. The preferred return can also be structured as simple or cumulative. Now, passive investors get the benefit of compounding with a cumulative preferred return structure, as it's actually calculated as a sum from the previous year's revenue. So for instance, let's assume that you invest in a syndication deal that's paying 7% pref. All right. Unfortunately, in year one, there's only enough cash flow to pay a 4%, which actually leaves us a deficit of 3%. 7 minus 4 is 3%. Follow me so far? Good. All right. So in year two, let's say that the asset earned 10%, which now that's just enough to cover you got the 7%, and it's just enough to cover year one deficit. In a syndication with a cumulative return, with a cumulative pref, the missing 3% in the first year is actually added to the passive investor's capital account. This actually increases the overall basis for calculating returns in year two. In situations like this, where there isn't enough cash flow to reach the hurdle rate in the first year, investors will be paid the remainder in future years as additional cash flow becomes available. The next structure is called a simple structure. Now, if we go back to this example right here, if this was structured in a simple preferred return, the investor would actually get the full 7% in year two plus the 3% that was owed from year one. Preferred returns may also be structured with a look-back provision. And if a syndication has a look-back provision, this means that if the limited partners do not achieve their agreed-upon return rate after the sale of the asset, then the sponsor, the general partners, they must give back a portion of the cash flow previously sent to them. One of the main reasons for a sponsor to do everything that they can to bring value to a property is to potentially exceed the return expectations, is owing to this look-back provision. Now, on the other hand, you got something called a catch-up provision. Now, a catch-up provision ensures that the limited partners receive 100% of the deal's cash flow until an agreed-upon rate of return is achieved. After that rate is met, all the funds will go to the general partner. In theory, the catch-up provision works the same as a look-back provision in that it helps guarantee that the limited partners get at least their intended return on investment. So let's talk a little bit, and let's end this with a quick example. So we have Dr. S. And Dr. S, he's actually really tired of trading his time treating patients for money. He decides to take action. He's educated himself on how passive investing and syndications can be used to replace his doctor income and has chosen to invest in a real estate syndication fund. Now, he looked at his checking account and could not believe he had $500,000 just sitting in there earning absolutely squat. So he takes his $500,000, he invests in a deal that's paying a 6% preferred return. This means that he's going to be paid $30,000, which is actually, if you take the $500,000, multiply by 6%, he's basically getting $30,000 tax deferred because of the depreciation. It's going to offset the passive income. 30 grand a year while he's holding this. Now, if the project pays out distributions at 10.5%, the sponsor has now surpassed the intended return of the 6%, right? 10.5%, 6.56%. So this leaves a 4.5% remainder. Thus, if this project had a 75-25 payout split, whenever the property sells, 75% of any extra money goes to the limited partners, and then 25% goes to the sponsor. Now, Unfortunately, too many times I see new members of my investing group, the Passive Investor Circle, they get in and they just try to overanalyze real estate deals, hoping to find the best opportunities, keeping them thus from never taking action. Now, if you decide to always sit on the sidelines and just always analyzing these things, unfortunately, you're never going to be in a position to start putting your money to work for you. You'll be like Dr. S. You'll keep having $500,000 in a checking account earning zero. Once you have a basic understanding of how this syndication process works, you have to get to the point where you have to realize that you're ready to then go out there and find a sponsor. That's the most important part of this, is the sponsor that you can trust and work with that can offer you a strong and realistic pref. Now, if you want private access to the sponsors that I personally invest with, and you're an accredited investor, then you can actually go to the link below this video, click to join the Passive Investor Circle. And if you want to continue to learn about how real estate investing can help you reach financial independence, I want you to check out my interview with one of the top real estate investing CPA groups around right over here. Check this out.